From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, drama in D.C. President Trump takes the pressure off Fed Chair Powell to new heights, as consumer sentiment climbs to a 5-month high despite the first signs of tariff-fueled inflation in consumer prices, as investors try to shut out the noise and focus on the Fed's next rate cut. But we begin with the big issue, drama in D.C. coming front and center.
If the market gets a whiff that we're losing Fed independence, then yeah, it's rates up.
Firing the Fed chair is really bad for the bond market.
It would really call into question the entire institutional structure that undergirds the Treasury markets as being the safest asset in the world.
This will induce inflation risk premium in the 10-year.
You can also see the beginnings of the inflation problem related to tariffs.
The tariffs could definitely create some inflationary headwinds.
The only thing that's certain is uncertainty.
This uncertainty is the very thing that's making it impossible for the Federal Reserve to say that we're out of the woods.
The risk is, of course, that they will be cutting prematurely.
It's not clear to me why the Fed should be cutting rates all the way down to close to 3% in this environment.
If they don't cut rates, that will probably bring down 10 and 30-year yields.
They do have some room to lower the policy rate. I think we'll see that in the second half of the year.
I think we will see a cut in December.
We've got penciled in as many as 3 cuts.
The data is going to be pretty clear that this is a tough cut until at least year end, and that's going to overwhelm, I think, the Fed's thinking on it.
Now, the chart I want to show you today is the betting odds on whether President Trump will fire Fed Chair Jay Powell. We have in the white poly market odds, Kalshi odds in the blue, and you can see through the course of the month they have been rising. And while they've come down a little bit, they have remained elevated. And of course, this is over the rhetoric this week of any potential for a legal dispute to the Fed chair from the president. Now, we will also take a look here over the 2-year yield because you have seen interest rates really fluctuating throughout the week. Now, much of what you're seeing in the shorter end here has to do with economic data. Calls for the Feds to lower rates are not just coming from the White House, and of course you're seeing them from Chris Waller as well. And you see that 2-year yield a little bit lower this morning on the heels of that call. Yet over here you can see that the shorter term rates have been higher. Hot retail sales data, hot consumer sentiment data this morning, not moving the needle a little more, but also jobless claims also hanging on in a pretty positive manner, showing the resilience from this economy. Now, certain Fed officials are also making calls for lower rates here. Based on what we're seeing in the underlying data, they're increasingly voicing support for those cuts to come sooner rather than later. Let's take a listen.
You can't wait forever, because if we wait till inflation gets to 2%, well, then we've lost. We've likely injured the economy in some way that was completely unnecessary.
Why wait till September if it's just 6 weeks? That's exactly the thing. It doesn't kind of matter. Just start thinking about, do I want to wait and risk something happening? We have to respond to real-time data to kind of sense of where the economy is going. And I've always said, if you worry about long and variable lags, which everybody always talks about, the whole point of that is to get ahead of it, not wait for it to happen.
Now let's bring in someone who spoke both with Mary Daly and Chris Waller earlier this week, throughout the course of the week. Bloomberg's Michael McKee. He comes to us from the Rocky Mountain Economic Summit in Idaho. We were talking about the push-pull between the rhetoric when it comes to the White House versus the Fed, but we were also talking about that economic data. There are clear implications for the bond market if you do see that Fed chair or Fed independence under pressure. Which is going to be the prevailing narrative throughout the course of the year?
Well, it's going to be a question of timing, as some of the people said in that segment. There is a feeling, at least on Wall Street, that they're not going to do anything until September. But there are a couple of people, including Chris Waller, who say that they should cut rates in July. And it brings up a question of what would Waller do if the majority voted the other way? Would he dissent? He told us today he hasn't made any decision on that yet. But remember, he's a candidate for Fed chair. And if you're going to be selected as Fed chair, you've got to impress the president. And the thing about the Waller situation is he knows the pressure that the Fed is under since he's on the Fed. And he did say today that if they don't have a credible Fed nominee, which I assume means anybody but him, then you could see the yield curve steepen and long rates go up, short rates would fall, and the bond market could have something of a conniption fit. So there are high stakes for this, and we don't know exactly when the president is going to nominate someone, but they have suggested it could come as early as this summer.
Bloomberg's Michael McKee, we have so enjoyed your coverage this week, and we're looking forward to you coming back home here with us to break it all down for us again next week. Now, joining us now, Steve Brown, CIO of Fixed Income at Guggenheim Investments, and George Bory, Chief Investment Strategist of Fixed Income at Allspring Global Investments. George, you look at where rates are right now. You look at the economic data that we've had coming in. What would you say about the potential for a rate cut as early as September, at least, based on the strength of the data we're seeing right now?
Yeah, no, thanks, Sonali. There's a strong possibility, as many of your prior quotes have highlighted. There is a growing case that rates could be coming down. But the important thing to emphasize is the urgency. The economy looks to be in pretty good shape, weathering at least the initial phases of tariffs pretty well. Growth is still positive, although decelerating somewhat. And very, very importantly, inflation's contained, with showing some upward pressure. There's not an urgency to move. And I think that really is the most important part. And if you look at the futures market, that would imply, or the futures market is implying, a fairly slow but steady kind of easing bias. And we think that's exactly the right strategy today. That if we do see some downward trends on the growth side, particularly in the labor market, the Fed stands ready, willing, and able to respond. We understand that they want to be as forward-looking as possible, but the current data doesn't suggest there's a high urgency to move. Now, clearly, the president would like lower rates, would like lower policy, and the data does suggest that we could move there. But there is a sort of this distinction between the economics driving the Fed and what the political agenda is with respect to lower rates. They're both kind of heading in the right direction, but there is that disconnect in terms of timing. We think lower rates are coming. We think it'll be in kind of the last third of the year. September could be the most likely first cut. But based on what we're seeing today, there isn't an urgency for fast and furious. It can be slow and steady. It can be methodical. And it can kind of lag the data a little bit, knowing what we know about the economy right now.
Steve, what do you think about the potential to cut in September? Do you see a rate cut necessary by any means, particularly on the heels of Christopher Waller's comments here? Do you think that it would look political if they start to move too soon?
No, I don't think so. And frankly, we think it's warranted. It kind of reminds us of last year a little bit. The Fed was kind of debating when to start easing off of what they viewed as a very restrictive level of the policy rate. And as we went throughout the year, whether it was the deceleration of inflation or maybe the growing risk in the labor market, it finally took that really weak July jobs report to not only get the Fed to move, but to move 50 basis points and then do 2 more cuts for the end of this year. So we think that type of environment is possible again. So the thing to watch in the next couple of weeks is the labor market. And then now with the pressure, you're getting more two-sided debate, if you will, on when they should move and how much they should care about what might be a temporary blip up in inflation.
George, what do you make of longer-term rates as well? Do you think that there is a case for a higher term premium if you think about all of the questions that surround central bank independence? Do you worry that we can go higher from here?
So the long end is reacting as the relief valve for both political risks, for economic risks, and now some questions about Fed and Fed independence. We think the Fed will remain independent. They will preserve their independence both in factual form but also in operational form, and that just the simple construct of the Fed makes it difficult to have one person exclusively dominate the agenda. But on the margin, could you see more political pressure? You absolutely could, and we've seen long end yields move higher. But also, there's a supply story, there's a deficit story that we know kind of got reinforced by the recent bill, the big beautiful bill that was approved a few weeks ago, and then not just here in the U.S. but around the world. There's a sort of a big move towards fiscal spending, deficit-driven fiscal spending, which needs to be funded. It's here in the U.S., it's in the U.K., it's in Europe, it's in Asia, it's in Japan. Developed market economies are, spending more than they earn, and the bond market will absorb that. So we think the relief valve is truly at the long end. Now levels matter. 5% becomes sort of an attractive entry point from yield perspective. We think that the 30-year could range between 5 and as high as 5.5%, given some of these pressures, especially if we were to see inflation tick up a little bit more as we go into the year. And the Fed actually, perhaps starts cutting rates. So we could see a meaningful steepening of the curve. We've already seen a steeper curve, but we think that trend is not over yet. It's a little bit in hibernation right now and could start to reassert itself, especially as the front end, looks like it might come down a little bit.
Steve, really quickly here for you too. In the next 30 seconds, what is your target for year-end 10-year, 30-year?
We would say lower from here. We've had a range-bound view. We're at the upper end of the range. And I think, as was just pointed out, the steepening of the yield curve is likely to continue. But at some point, a steeper yield curve can actually be supportive for long-end demand and technicals, as the risk between reinvestment risk and having a lower yield at the front end can be compensated by taking a little bit more duration risk to generate a significantly higher yield if we were to get a much steeper yield curve.
Still a trader's market. Our thanks to Steve Brown of Guggenheim and George Bory of Allspring Global Investments. We thank you so much, and happy Friday to both of you. Up next, the auction block. We're going to look at the global credit issuance as Japanese firms storm the U.S. debt market, creating buzz around so-called reverse samurai bonds. Details on that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we have reverse Yankee and reverse Samurai deals this week, starting with the U.S. banks, who after their earnings came out with debt deals. Morgan Stanley, JP Morgan, Citigroup, Wells Fargo, and PNC with offerings. Wells and Citi tapping the European market as well in so-called reverse Yankee deals. And we also have seen a surge of reverse samurai bonds, where Japanese companies are heading overseas to borrow. Last week, it was NTT and Nissan. This week, we saw semi company Kioxia raise more than $2 billion in the junk U.S. market. Plus, we are having the busiest week for U.S. leveraged loans since the start of the year, with volume near $50 billion. Deals are still coming in on this Friday, likely to raise that number even higher. Speaking of credit, earlier this week, we caught up with Vanguard's Sarah Devereaux and asked her where she's positioning.
Discipline really delivers. We believe it's good to be up in quality. There are attractive yields to be had. All-in yields are attractive, but spreads are tight. So we're really leaning into security selection, and we are keeping some dry powder on the side to deploy if spreads should widen. We're also pairing our IG overweight with long duration in the belly of the curve. Really, it's like you call it a recession insurance.
Joining us now, Amanda Lynam, head of macro credit research at BlackRock, and Colleen Cunniffe, co-head of global taxable credit research at Vanguard. Amanda, there's been a lot of rush into riskier debt right now. My big question is the risk being seen outside of the public credit markets? Is it being pushed out to private markets, given how much the high yield markets have become safer over the last couple of years?
Sure. Good afternoon. Thank you for having me. If I think really the key message from my perspective for investors is that corporates, both liquid and private, have been navigating this backdrop with a fair amount of resilience. There's certainly dispersion, right? So we're no longer in a rising tide lifts all boats. There's definitely differentiation, even within certain sectors. You can see that. But I think you talked about it in the earlier segment, the resilience of the economy, the resilience of corporates to navigate policy uncertainty. It's really been striking. As it relates to the left tail pockets of the market, you see that in both markets, liquid and private. You can see that in, for example, triple C's and high yield, interest coverage is already at 1 time, so not a ton of cushion. You see it in certain pockets of private credit where there's a bit more dispersion. But in general, I think the message is one of resilience. It leaves us selectively comfortable moving down in credit quality, not all the way down the risk spectrum, but definitely, I would say, taking advantage of some of the opportunities to add incremental return. As the segment showed, even though spreads are tight, yields are attractive.
Spreads are so tight. Colleen, what do you think about where we are in terms of valuation right now? I would love for you to cover more on that interest coverage part of the scenario here too. Is there enough cushion in this market to support how much money has been flowing in?
Yeah, thanks for having me. Valuations, just tagging onto what Amanda just said, valuations on a spread basis are, getting to their all-time height, single-digit percentiles. There are some attractive yields, but, that has been a little bit less so than it was even a few months ago. So this is a market that we're focused on the high yield side of really avoiding the downside. And so when you bring up the issue of interest coverage and looking at some of the numbers, right, on the CCC side of the market aggregated, you've got about 1-time coverage, as Amanda noted. On the higher quality side of the market, you're seeing stronger balance sheets, so a little bit better profiles there. So does it have enough cushion? It depends on where you want to play. We're very, very cautious on the CCC side of the market. Performance has lagged there, so far. The higher quality part of the market, you've got to pick your spots and work through those deals.
Selectively moving down in credit risk leads me to the question, what's a better risk right now, Amanda? Would you prefer duration risk or would you prefer credit risk?
I would say credit risk. So for an investor that's confined to the investment grade category, for example, we would like moving down into triple Bs. For an investor with a bit of a more flexible mandate, that high end of high yield screens pretty attractive. You're picking up some incremental spread. You're actually not giving much in terms of credit fundamentals. Actually, the high end of high yield in many instances looks very similar to the low end of investment grade. I think if you're really allocating to corporate credit, our recommendation is do that for income, for carry, for yield, not because you think there's scope for a material decline in interest rates and not because spreads are moving much tighter, because as Colleen noted, they're already pretty tight. But it's really that income opportunity, and I would say that would leave us towards the shorter and belly part of the curve as opposed to the long end.
So, Colleen, what does that mean in terms of the parts of the market that you're avoiding? Because there's still a fair bit of caution when it comes to credit risk, it seems like. So what is worth still staying away from?
Yeah, and so I'll just tag on to the answer of the previous question. I'll show my bias. As a career high yield person, I'm always going to answer that credit question is probably credit risk. But things were so. What we say is we're looking to maximize our carry using both issuers and sectors that we like and moving down in capital structure as opposed to really moving down, far into the really low credit quality. So that's kind of how we're deploying it. And I think once you get down into the CCC universe, that's not, as a beta play. So to say that we're looking for the stories we want to avoid, and we're looking for the stories where there's potential for value appreciation, and one that where we can have some foresight into how we think things are going to play out. So I wouldn't necessarily say this sector, that sector, that sector. It's really story based at this point on the high yield and the low quality high yield part of the market.
Now, you mentioned a little earlier, Amanda, you wouldn't count on rate cuts right now in order to make new bets. But in the event that we do see at least one this year, what would that change in terms of the way you would allocate money into credit assets right now?
Sure. So I think the direction of travel for rates is pretty clear, lower. I don't necessarily see a strong urgency for a near-term rate cut. If we have 1 or 2 rate cuts by the end of this year, that provides some incremental relief for floating rate borrowers. But I don't think it actually materially changes the all-in yield attractiveness of corporate credit, perhaps on the margin. But I think that would actually be a welcome relief. We do still quietly have default rates that are creeping higher. It hasn't been enough to derail performance. But I do think that some of the borrowers, the stretched capital structures would welcome that. But I don't think that it's game-changing really in terms of fundamentals or really in the way that we would invest.
I'm glad that you brought that up, because a lot of people want to ignore that default rate because it's still so historically low. But yes, it has been creeping up. We have seen actually the pace of bankruptcies rise to the pace we haven't seen in more than a decade. And we have a story on the Bloomberg terminal right now that says blame it on the tariffs. CEOs are rolling out new excuses for those bankruptcies. Colleen, you look at the tariff pressure, and my question is it just tariffs? Or is there something else that's eating at the lower end of the spectrum at credit quality right now, given that rates have been so high for so long?
Yeah, no, and no, is it just tariffs? No, it's not. And it's rare ever that, a single piece of data or single force pushes a company into a bankruptcy. It's a setup, right? You've got a, maybe a weaker industry profile, a high leverage, and then something, idiosyncratic like the tariff situation might happen to push them over that edge. But no, you can't just say it's tariffs and that's what's causing that. On the lower quality part of the market, to your point, we've had more aggressive capital structures and much lower interest coverage. So when one little thing happens, that's when you end up in front of a judge or in front of your creditor committee.
Amanda, what do you think about leveraged loans right now? Speaking of risky debt, it looks like a market that's knocking on the door again to do deals, especially private equity-backed ones. Would you be a buyer?
Yeah, actually, high yield and leveraged loans have outperformed investment grade so far year to date on a total return basis. So for all of the focus on default activity, again, it hasn't been enough to derail performance. I do think that floating rate income is attractive. Again, we do not see near-term significant rate cuts. I think you do have to be careful, though. There are some real differences between sector exposures, between high yield and leveraged loans, for example, different ratings distributions. But in general, that sort of credit risk, I think, is really attractive from a yield perspective.
And as the economic data stays pretty strong, it makes up for an interesting setup. Amanda Lynam of BlackRock and Colleen Cunniffe of Vanguard, we thank you so very much for joining us this Friday. And if you can't get enough talk on credit, which I cannot, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Plus, you get to meet some more members of the market and all they have to say about many diverging views. Now, still ahead, the final spread, the week ahead, Magnificent 7 earnings kickoff, plus an ECB rate decision and remarks from Fed Chair Powell. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, Treasury Secretary Scott Bessent visits Japan for trade talks, plus earnings from Verizon and Domino's. Tuesday, Fed Chair Powell speaks. GM reports earnings alongside Coca-Cola. And Wednesday, Magnificent 7 earnings kickoff with Tesla and Alphabet, plus earnings from AT&T, Hasbro, and General Dynamics. Thursday, an ECB rate decision, the EU-China summit, and European bank earnings. And Friday, President Trump heads to Scotland. But that does it from us, from New York. That does it. Same time, same place next week. This is Bloomberg Real Yield.